on a scale of 1 to 10, if you had to rate the U.S. consumer based on what the banks were saying, 1 being worst, 10 being best, what rating would you give them?
Well, we're probably around an 8 at this point. I would say certainly the banks have already added to reserves ahead. If you think back a quarter or two, they were looking for a slowdown in the economy. They were looking for higher unemployment, above this kind of 4% level, 5 to 5.5. I think that's where banks start to get a bit worried that they have enough in reserves. And we've had some pockets of weakness in credit card and auto loans, particularly at the lower end consumer. There's definitely a bifurcation there at income levels when it comes to credit quality and growth also. So I'd say it was pretty solid in terms of the how consumers have been reacting. One thing I didn't mention as well is that the deposit costs. There was a lot of pricing pressure when rates hit their peak and until the Fed started to reduce. So that was a problem going back about a year. So even the costs on that deposit pricing pressure was not there this quarter. So banks are they're okay in this higher for longer interest rate environment, and that's because they're big holders of fixed income securities, and those move up in value or stay higher in value as rates are where they are, and they're able to reprice those as their lower yielding securities are maturing. They're able to put those into higher yielding securities. So that's actually been a benefit. I think if you talk to the average bank, they'd say, well, a little bit lower rates would be good because that would help stimulate loan growth, which has, again, this kind of low single digit level. They like that to be a little bit higher. But higher for longer is not universally bad for banks by any means.